Hello everyone, welcome back to Crypto Partner Club. I'm Mauro Terrinoni, former investment banker, and today we are analyzing stablecoins, the digital currency that is becoming a critical asset in the global economy. In this video, we're going to cover three things. First, why stablecoins were created and how they solve the problems that banks can't fix. Second, how analysts predict stablecoin volumes could reach $700 trillion within 10 years. And third, how stablecoin issuers like Tether made billions of dollars in profit last year. By the end, you'll understand whether stablecoins are just a crypto trading tool or the future foundation of global payments. Let's dive in. Let me start with the problem stablecoins were designed to solve. This is Bitcoin in the last month. You can see the trading price fluctuating up and down. Now, I will add the largest and most liquid stablecoin to the same chart, Tether USDT, overlapping on the same screen. You see, it does not move, it sticks to parity. In the early 2010s, Bitcoin and Ethereum were a revolutionary innovation, but they had one fatal flaw for everyday use: extreme volatility. Back then, prices could swing 10 to 20% in a single day. Imagine trying to run a business where your cash balance drops 20% overnight. Impossible. Crypto traders face this problem constantly, then make a profit trading Bitcoin. But then what? If they wanted to wait before the next trade, they had basically two options. Option one, they could convert back to standard dollars. In crypto jargon, it's called Fiat dollars. But that meant the bank transfers could take a few days, plus fees for international wires. Option two would be to hold Bitcoin or Ethereum, but that would risk that their profits could potentially evaporate as prices would come swing back. The solution arrived in 2014 with the launch of BitUSD, the first stablecoin that was designed to maintain a one-to-one peg with the US dollar. However, BitUSD failed because it lost its peg in 2018, but the concept was working. So later in 2014, Tether launched RealCoin with a simpler model. For each Tether coin issued, the company would hold one actual US dollar in reserve. This was a breakthrough because traders could now park their capital within the crypto digital ecosystem without the need to switch to traditional dollars. In a stable digital asset, move it instantly across blockchains and avoid both volatility and slow banking rails. From a traditional finance perspective, stablecoins solved a settlement problem. So the gap between the time when a transaction is closed and when funds actually move. In crypto, that gap went from days to seconds. Fast forward to 2026 and the stablecoin market is now over $300 billion. The number one player is Tether, that goes by the symbol USDT, with $180 billion market cap. The original stablecoin from 2014, this is still dominant with nearly 60% market share. Number two is USD coin, USDC, with market cap approximately $80 billion. Issued by Circle, which went public on the New York Stock Exchange in June 2025. Circle publishes monthly attestations from Deloitte, showing 100% backing in US Treasury bills and cash. And this transparency makes USDC the preferred choice for institutions. So the two have a combined market share of over 80% of the stablecoin market. There are other types of stablecoins that are not secured by US treasuries. For example, Athena USDe that tracks the US dollar using delta neutral derivative strategies rather than holding treasury bills. Therefore, this is somewhat more risky than USDT and USDC. And there are several other smaller issuers. So far, we talked about US dollar stablecoins. As a matter of fact, 99% of stablecoin value tracks the US dollar, even though there are lots of other global currencies and large economies. Currently, euro-backed stablecoins account only for $500 million. That's less than 1% of the total market cap. But this is changing. In 2025 and early 2026, we have seen new major launches. EURC from Circle, for example, JPYC that tracks the Japanese yen, and then new stablecoins tracking Singapore dollars and other regional currencies like in Brazil, in Colombia, and New Zealand. Launching stablecoins on other currencies allows users to avoid transferring their balances into US dollar and then back into the currencies deployed. However, if you think that non-US dollar currencies make up for over 40% of daily forex versus only 1% of stablecoin issuances, you realize there's still a large gap that is closing. However, dollars will most likely remain the dominant stablecoins for many years. Now, we should also mention that there are some stablecoins that track physical commodities rather than currencies, and the most common are gold-backed stablecoins. Those include Pax Gold, for which each coin represents 1 ounce of gold stored in London vaults. And then there is Tether Gold, for which each coin represents 1 ounce of gold held in Swiss vaults. Gold stablecoins allow you to own a fraction of gold. So, for example, 0.1 ounce without the hassle of physical storage, of insurance, of security. The commodity-backed stablecoin market reached approximately $2 billion, and it's up 60% from the year before, but still only less than 1% of the total stablecoin market. And other examples include stablecoins of silver, or oil, and other commodities. From an investment banking perspective, commodity-backed stablecoins serve a different function than fiat-backed stablecoins. They are not stability plays, they are inflation hedges. So, for example, gold-backed tokens fluctuate with gold's market price. They're less volatile than Bitcoin, but more volatile than USDT. The key advantage, you get blockchain efficiency like instant transfers, fractional ownership, 24/7 markets, without needing to physically store the underlying commodity. Before we continue, if you're finding this analysis helpful, hit subscribe. I post weekly videos analyzing crypto through traditional finance frameworks. No hype, no paid promotions, just fundamentals. Let's now look at what may come next for stablecoins, as this is the most interesting part. There are a couple of key drivers that may push stablecoins to an enormous total market capitalization. The catalyst one is the generational wealth transfer. In the next 20 years, an estimated $100 trillion will move from baby boomers to millennials and Gen Z. And this matters because of one data point. Nearly 50% of millennials and Gen Z have held or currently hold crypto, according to a Gemini 2025 survey. For this new generation, crypto isn't something they adopt, it's their default. Just like boomers defaulted to banking, millennials and Gen Z default to digital native assets. The catalyst too is the point of sale integration. Think about credit cards. In the 70s, using a credit card was unusual, but by the 90s, it was default. So stablecoins are heading towards the same transition. When merchants integrate stablecoin payments directly into the checkout systems, consumers won't think, I'm using crypto. They will just do it. As a result of these macro trends, a recent paper from Chainalysis predicted that stablecoin market caps may hit an incredible size of $700 trillion within 10 years. This is a staggering number. Visa and MasterCard combined process about $20 trillion annually, so this prediction would put stablecoin volumes 30 times the Visa and MasterCard payment volumes. Let me now walk you through the business model of stablecoin issuers to explain how they manage to earn billions of dollars in profits. The primary revenue is interest income on treasury bills. When you mint one USDC, you give Circle $1, and Circle deposits that dollar into the Circle Reserve Fund, which is a government money market fund managed by BlackRock and registered with the SEC. The fund invests in short-term US treasuries and overnight repurchase agreements, so-called repos. So Circle earns the interest income earned from those fixed income securities and keeps it entirely. The secondary revenue are transaction fees. For example, Tether charges a 0.1% redemption fee with $1,000 minimum, which discourages small redemptions. These are the two main revenue streams for stablecoin issuers. And then there are new revenue streams launched in 2025 and 2026. For example, Circle launched the Circle Payment Network, which is like a Visa but for stablecoins, and charged transaction fees as money moves through the network. But here's the risk of the business of the stablecoin issuers. The profitability is tied to Federal Reserve interest rates. When rates are high, issuers make billions of dollars. When rates fall, revenue also falls. And that's why Circle is racing to diversify transaction fees into SAS, infrastructure services, to reduce dependencies on interest income. From a traditional finance perspective, stablecoin issuers operate like a money market fund with extremely low expense ratios and massive asset bases. It's an extraordinarily profitable business model, particularly when rates are high. So the question is, will issuers start sharing interest income with holders? Currently, the large issuers are not sharing anything, but new competitors are emerging. For example, yield-bearing stablecoins were launched that explicitly pass interest rates to holders. These products are smaller and less liquid than USDT or USDC, so they offer income but present additional operational risks. The likely future is that there will be a two-tier market: free stablecoins like USDT and USDC with no yield but maximum liquidity, and widespread adoption, and yield-bearing stablecoins that share returns but have smaller market share. From a traditional finance perspective, this mirrors the difference between free checking accounts and money market funds. Most people use free checking for liquidity, and other people use money market for fun. Some people use free checking for liquidity and money markets for yields. Stablecoins are heading towards the same bifurcation. So here's my summary on stablecoins. Stablecoins will be instrumental for the replacement of legacy payment rails used for cross-border transfers, because stablecoins enable instant settlement and programmable money. SWIFT and wire transfers are expensive and slow, while stablecoins are faster and cheaper. Markets are clearly embracing such efficiency and lower transaction costs. We are moving towards a multi-currency stablecoin world. The dollar will stay dominant, but euro, yen, regional currency stablecoins are closing the gap and eroding the US-denominated stablecoin market share. Moreover, stablecoins will evolve from purely liquidity assets to yield-earning assets. Also, the regulatory framework evolved favorably with the Genius Act in the US and MiCA in Europe that frame stablecoins as regulated payment instruments, not speculative trading assets. That's the legitimacy they needed to scale with institutional adoption. In summary, stablecoins are becoming the foundational payment layer of the digital economy. The question isn't whether stablecoins will grow, but how fast. This is all for today. If you found this analysis helpful, hit subscribe. I post weekly videos analyzing crypto through traditional finance frameworks. No hype, no paid promotions, just fundamentals. See you at the next video.